Hello and welcome to Earnings Echo. We put together the most important information about Shopify.
And honestly, if you just look at the headline numbers for Q4 2025, you'd be wondering why the market reacted the way it did.
Exactly. I mean, on paper, this was a massive win.
A huge one. Yeah. Let's just run through the hard data. Revenue came in at $3.67 billion.
Okay.
That's up 31% year over year. Then you have earnings per share at 0.57 cents.
And the big one, GMV.
Gross merchandise volume, right. That hit $124 billion, also up 31%. I mean, that's their strongest growth since the pandemic boom in 2021.
So revenue and profit both crushed the analyst consensus, a textbook double beat.
By every single operational metric, yes.
And yet the stock chart looked like a roller coaster. Pre-market investors were thrilled. The stock jumped, what, almost 11%?
It did around $141, yeah.
Then the opening bell rings, the outlook gets digested, and the floor just falls out. The stock didn't just fall, it crashed over 12% during the session.
A complete 180-degree turn. All that initial buying pressure just vanished.
So before we get into the why of that crash, we should probably, give credit where it's due. That 31% growth, it didn't come from nowhere. What was actually driving it?
Well, what's so interesting is that it wasn't just the core online store business. The growth is really diversifying.
How so?
International revenue, for one, is actually growing faster than North America now. It was up 36%. And their physical retail solution, the offline revenue, that was up 27%.
So they're really pushing beyond just e-commerce. It's an omni-channel play.
Exactly. But the real shocker was B2B. Their business-to-business GMV exploded.
I saw that number. It was
96% growth. It basically doubled in a single year. That's just massive scaling.
Which is a huge vote of confidence from enterprise clients. And they're making money doing it. They closed Q4 with a free cash flow margin of 19%.
And that's their 10th straight quarter of double-digit cash flow margins.
They even threw in a capital allocation update. The board greenlit a new $2 billion share buyback, which, brings us back to the big mystery. You've got 30+% growth, fat cash margins, a $2 billion buyback.
Usually that's a recipe for a stock to go up.
It should put a floor under the price, right? But it didn't. What did investors see on the horizon that spooked them so badly?
It all came down to one thing. The guidance for Q1 2026.
Okay.
The revenue part was fine, actually. They guided for growth in the low 30s, so stable. The problem was the cost side.
The margins.
The margins. They're projecting free cash flow margins to drop a lot. From that 19% high in Q4 down to the low to mid-teens.
So something like 12% to 15%, that's a sharp step down. I was listening to the call, and President Harley Finkelstein, he framed this very deliberately. He called 2025 full throttle, but he's calling 2026 the year of the builders.
And we know what building means in Wall Street terms. It means spending.
Right, so this margin drop isn't a mistake. It's a strategic, heavy investment cycle. They're going all in on AI.
Things like agentic commerce, Sidekick, the Universal Commerce Protocol, all that future-facing tech.
But the issue here isn't really the strategy itself, is it? It's the valuation.
That is the critical context. Coming into this report, Shopify was trading at a PE ratio of over 80.
It was priced for absolute perfection. You don't get the luxury of a transition year at that multiple.
Exactly. Investors were paying a premium for both high growth and expanding margins. So when management signals that margins are going to contract, even for a good reason like AI investment, the math just changes for a lot of people.
It's that classic conflict, isn't it? The long-term vision of building an AI-powered commerce OS clashing with the short-term demand for profit efficiency.
A perfect summary.
So what's the final echo for investors to take away from this? Is the long-term story broken?
No, not at all. The story is incredibly intact. I mean, you have a company doing over $11.6 billion a year in revenue that is still growing at over 30%. That's almost unheard of at this scale.
But the trade-off is accepting a different timeline.
Precisely. Investors have to be willing to accept that for the next few quarters, profitability is taking a back seat to building out that AI infrastructure.
So the fundamentals are strong, but we are entering a costly investment phase, and it's happening in a valuation environment that has absolutely zero patience for margin compression.
That's the takeaway right there.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked. Portfolio prepped. Catch you again soon.